We'll get started. Hello again, everybody. Welcome to the HLC Equity Market Update webinar for Q1 of 2024. My name is Kevin Aschman. I'm the Director of Marketing for HLC Equity. Our normal host, CEO Daniel Farber, he had a schedule conflict, so he asked that I stand in today to make sure that we continue forth with what's easily one of the most insight-driven discussions that we host here at HLC. So I'm joined by two members of our leadership team. If you've been with us for any of our previous quarterly updates, they may look familiar, but Dave Molitor is HLC's head of operations, and Cesar Nguyen leads our acquisition efforts as the director of acquisitions. So quick outline of today's agenda. We'll start with Cesar kind of speaking to some of the economic and market trends that have occurred over the past quarter and kind of how that's impacting our acquisition efforts. And then Dave will walk us through an overview of our operations and property management and the performance over the last quarter as well. And then after that, we did receive a good number of questions from our registrants and attendees, so we want to make sure that we leave some time to get to some of those at the end as well. So without further ado, let's get into it. Cesar, do you want to kick us off here?
Absolutely. Yeah,
All
Kevin,
right.
thanks so much. And thanks everyone for spending time with us today. So yes, on my end, we'd love to dive into the overall economy and what we see on the investment side. Gonna go to the next page. In terms of, I think the biggest thing that the elephant in the room is the interest rate. Where interest rate going to be? So looking at over the 10 years, we start this year at around 3.9%, and it spiked up to 4.7, and now landing around 4.3, 4.4%. I think this is mainly driven by the Fed. Obviously, earlier this year, people looking at the inflation data, people are thinking, oh, inflation has cooled off now. The Fed can start tapering down their campaign of hiking interest rate, and folks was projecting up to 6 rate cut this year. But with the persistent inflation data coming in still quite high, that hope has come down to maybe 2 rate cut or maybe 1 rate cut this year. That's to dampen the investment market. And we see that too, that kind of also reflect the investment sale market. Um, Earlier this year, when the 10-year was going down to 3.9%, we saw investment sale listing pick up quite a bit. We had a lot of different type listings. A lot of them was free and clear of existing debt alongside a simple loan. But now majority of the listing that we see is mainly assumable debt with long-term fixed rate debt in place. And the free and clear listing, we don't see a lot more of that. It's just based on because the number doesn't pencil. And looking at the overall investment sale market, the volume is down 12% compared to the same time last year. And I think we found the bottom in terms of the kind of market activity. And I do expect the market will slowly recover from this point onward. Moving to next slide. So looking at overall market sentiment, when we are actively in the market looking at deals, but also talking to other shop looking at multifamily, people are still active. People are still looking at deals in general. CBRE, did a global investor survey in Q1, and of the data they found, multifamily and industrial, they are still the darling of the investment industry. Everyone is still focusing on these two sectors. And within the multifamily sectors, they did not see, among the respondents, very little or no price discount, the expectation coming into 2024. You see the chart on the right, you look at the multifamily, for example, roughly a little bit more than half of the participants expect small to moderate discount in multifamily, which is consistent with our view. Multifamily is still a sector that have a strong tailwind, especially with rental demand. Uh, it's very difficult to get housing in this environment to purchase home because the interest rate is really high. So most people will continue to rent for a longer period of time, and that demand will keep the pricing in pace. The only extent where we see a deep discount is where distressed multifamily, which we'll touch on in a few slides. Go on to the next page. Also, in terms of where the recovery period will happen, that's the question in everyone's mind. Where is the bottom and where do we expect the market to recover? Most folks are in the camp of, second half of 2024, and then some in the first half of 2025. Actually, within HLC equity, we right in between there. We think at the end this year is where we think the bottom will be. The reason why we say that, because there was a lot of extend and pretend from the lender side of things. A lot of lender within 2023 was willing to work with borrower to give them loan modification or extension to kick the can down the road. That can now is here in terms of second half of 2024, and they no longer can afford another extension or so. So that transaction, we expect transaction activity will pick up in second half of 2024. Certainly, what it lead to interesting deal, is remain to be seen how deep the discount is. It really depends on market and asset, and also the seller situation is a very deal by deal basis. Um, and the major challenge we expect, going into 2024 and 2025, also similar to other shop, is that rate will remain higher for longer, which make it tougher to get deal to pencil, and also a bit tougher to get the adequate leverage when they go out to borrow money. And the last piece is the mismatch of expectation between buyer and seller. For us, we've been very active in putting out offer. We've been setting out 2, 3 offer a week to multifamily across the Sunbelt market, but we are consistently between 10 to 15% below the pricing expectation from what the seller want. And it's just a reflection of today's market. We only want to buy deal that have a decent leverage going in, and have adequate protection, downside protection for us. And those do not work for what the seller looking for. So go to the next slide. What we are watching. We're watching. We spend a lot of time, looking at overall macro economy, thinking about supply and demand. As if you attend our webinar previously, you know that there's a huge waste of supply in the Sunbelt market because a lot of construction, they all deliver in 2024 and 2025. And there's a lot of demand in the Sunbelt market overall because of strong migrations, a lot of job growth, a lot of population growth, but that demand is still outpaced by supply, which will create some short-term pain in general on the leasing side and the things. But it also create opportunity for patient group like us who wait for the right time to come in and buy a deal at the attractive basis. A lot of this headwind on the leasing front will impact the overall performance of property, which allow us to buy deal at a great basis. Go to the next slide. Also, as I mentioned, as I touched on earlier, I think we are at the bottom of the market. Whether we are at the absolute bottom, nobody knows. Even Blackstone and Starwood, they disagree with each other on, where is the bottom and how are we in a soft landing, a hard landing, and how bad it can get. And those, all the institutional firms, they have access to millions of data, proprietary data that they see within their own portfolio, as well as third-party research data that they see. And depends on what set of data you look at, you come to a different conclusions. But from our perspective, I think this will is a strong indication of we are right around the bottom, because once all a major player agree with each other that the upcycle is here, is already too late. Only this time where they disagree on where we are on the bottom, I think that's where the bottom is. It's just, this is our house view. And on the other end, we're also looking at the overall the American consumer, of how, with inflation in the economy, how the look, we track the data on employment, track the data on layoff, also consumer spending. And one of the things that it caught our attention is that the US personal saving rate had dropped out to 3.2% in Q1, which is is the same level of pre-pandemic level. And you look at the delinquency by loan type, this is data from the New York Fed. Um, of all the type of consumer loan, mortgage, credit card, and auto loan has picked up quite a bit over the last 2 quarters. Is something that we are watching, because that certainly will create some strain on consumer budget. And look at you if you any kind of show in the share of max out credit card among consumer. Um, it's the chart on the right, all the way to the right. It had pick up to all the way to pre-pandemic level, which does it just point out to us that American consumer, they have spent out all of their saving, and now they tap into credit card to start, to supplement their living expense. And that if this trend continue, it's certainly a cause of concern overall. And that's something that we are watching closely. Go to the next page. So lastly, what we are pursuing, so we still stick to our same thesis of income and growth. Obviously, we still want to buy Class B workforce housing property at 6 cap and higher to achieve net neutral leverage going in. Those are difficult to achieve in tier one market. If you buy deals in Dallas, and Atlanta, major metro, those deals are still trading in a mid 5 cap. So if you want to get a 6 cap and higher, you obviously need to go into secondary market. And those, we have here the data from Yardi and Moody's, the top 15 markets of strong population growth and strong rent growth. As you can see here, a lot of it was in secondary market, in general, on the rent growth, and then population growth is major Sunbelt markets. We will still focus our times in a lot of this area, but more on these, not in urban, not in the core area of Sunbelt market, but more of a suburb within 30 to 40-minute range of downtown or midtown commutes. That's where we think we can find Class B workforce housing deal with a 6 cap. And that will allow us to drive positive leverage going in. The second segment of this is still growth of the Class A apartment that we're actively reaching out to owner developer with upcoming construction loan maturity to see if they want to sell. And this is, as I mentioned before, this is where we still about 10 to 15% below their pricing expectations. They still don't want to take a loss on that front. They still want to, to get some kind of profit selling this deal, and we don't think that the pricing truly reflected. We were fairly close to some deal, but we was very disciplined in our approach, make sure that we buy at the right basis. And if any of you follow our webinar, you see that we added a third leg of the stool here called distress. We've been tracking this market for a long time, over the last year and a half. We have our own database of deal that we think and we know will be distressed because the way it was structured. And we were hoping that those deals will come out at the end of 2023, but because of the extended pretend, they got kicked, those deals got extended to 2024. And now we start to see those coming out. We have actively built our direct relationship with lenders And we start getting call from them directly. Some lenders, they have booked this loan on their book. They don't want to offload before quarter end or before year end. They don't want to see how they don't want to, lenders not in the business of owning real estate. They want to sell the note and then move on. And we were very fortunate to have a lot of the listing off market come to us. And we say no to a lot of them, but we are fairly close on a handful that we think are really attractive opportunity that will be buying at the lender basis. Doing those will allow us to essentially almost virtually eliminate the downside risk on the deal because we buy such a great basis. We just have to deal with some level of complexity on the deal level, like operational and take a year or two to turn it around. And once that is done, you own a great asset in a good location at a great basis. So that's where we are. And I think for us, moving forward in Q2 of 2024 and later half this year, distress will take up a decent chunk of our activity because those deals now are starting to come out and we're able to buy the great basis. So yeah, so that's where we are today. More than happy to address some of this in the Q&A session. That's it. Thank you.
Okay, great. We'll keep it moving here and head into kind of the operations discussion. Dave, you want to take it away?
Yeah, sure. Yeah, thanks, Caesar. Thanks, Kevin. Good afternoon, everyone. So moving over to property operations, if we can go to the next slide. I want to start off by discussing leasing trends in the broader DFW market. On this slide, we have three charts from CoStar. They're showing kind of different key metrics concerning occupancy and market rental rates for Class A and B properties only in the DFW area. So starting with the first chart labeled occupancy and market rent per unit, I think highlighted this chart because it shows really the declining occupancy rate that's continued to basically free fall over the last several quarters. It's now approaching 88% in the DFW area. Now that's including lease-up properties, so it's a little bit higher on stabilized properties, but the trend is down in both cases. While the forecast, looking forward from 2024 through 2026, we have in this chart, it suggests a bottoming in Q2 of 2024. And that does seem to be materializing based on what we're seeing on the ground, and I'll get into that in a little bit. It has been almost 3 years of decline since the market peaked in Q2 2021. So, this has been a long stretch of downward momentum, and it's good to see that things are potentially stabilizing here, but we've dropped quite a bit from kind of the above 93% on the market level in DFW back in 2020, 2021. So moving to the second chart, which is really another kind of showing similar data, but really I selected it just because it adds kind of the year-over-year rent growth trends. So, in 2022, Q2 2022, rents peaked in the DFW market. And for a while after that rent peak, there was still year-over-year rent growth. In our portfolio, and I guess presumably in the broader market, this was really a reflection of the rapid rise in rents in 2021, and then the fact that leases don't turn over except every 12 months. And so there were people who had locked in at lower rents. So even though the asking rents and the market rents started dropping after Q2 2022, you had such a disconnect between those who had leased earlier in 2021, whose leases were now expiring, and the current market rents, that even though they were dropping, there was still a lot of room there to push the rates on renewals and on new leases, for those expiring leases. So that kind of changed. It took about 12 months, and then it changed. And as you can see in the chart, for the past 4 quarters, year-over-year rent growth has actually declined. And it declined the most in the most recent quarter in Q1 2024. Now, I expect that the forecast in the chart for the next 2 or 3 quarters is probably correct. From what we're seeing, market rents appear to have bottomed out and are starting to move back up a bit. And that's kind of reflected in the CoStar forecast. However, I think it's hard to say definitively if this is a trend that will continue. I know the forecast shows that it continues, but as I'll get into a little bit later, there's some feeling on the ground. It just doesn't feel like it's a robust kind of recovery. The leasing activity we're seeing just doesn't seem to be where it needs to be to sustain rent growth. Maybe occupancy levels, but not so much rent growth. So again, I'll talk about that a little bit more as we discuss our portfolio performance in the next slide. But before we move there, I just want to touch on also the new unit deliveries. Caesar touched on this a bit too. But this third chart, I think it does a nice job of kind of showing quarter by quarter the deliveries versus the absorption rates. Q1 2024 actually had the highest net deliveries, at least in this chart going back 10 years. And for the next 2 quarters, deliveries are projected to continue to outpace absorption rates. The new product is having a significant effect on the market. In my opinion, it is generally the primary contributor to the weakness in rents and occupancy. Apartments in lease up that we've seen that we compete against are offering up to 2 months free plus discounted rents, which makes it very difficult for stabilized properties to push rents at all. And it's difficult to match those whenever you're not in the lease up. The lease up properties build this into their budget. We don't have that in our budget. 2 months free is kind of unheard of. And so it's a little bit difficult to compete with them, and they're really taking a good portion of the market share in terms of new lease activity, and kind of putting pressure on our rents just to try to kind of maintain our occupancy. So that's been difficult. Again, it has kind of improved here in the beginning of Q2, but that's been a trend that's been ongoing now for quite some time. And if you look at the chart, I think the deliveries are projected to outpace the absorption rates for the next 2 quarters anyway, and then kind of switch in the end of 2024 and beginning of 2025. Okay, moving to the next slide. So in this slide, we're looking at kind of our HLC portfolio leasing trends for Q1. And it's been pretty consistent with the broader DFW market. However, it's important to note that this is our portfolio data, and individual properties some are performing better or worse. But as a whole, I think I just touched on pretty much applies to our portfolio. So kind of starting with the physical occupancy in Q1 2024, our average portfolio physical occupancy was approximately 91.5%. The average dipped as low as 90.5% in January, with some properties going into the high 80s, actually, before gradually improving, and we kind of averaged out at 92.3% in March. And this improvement has continued. April was better, and May is also better. We're back up to around 94% on the portfolio in terms of our occupancy, but we certainly felt it was a difficult Q1. We are starting to see some signs of leasing traffic slowdown over the past couple of weeks, although our occupancies remain higher. So hopefully it's just a bit of a lull and not a trend. Moving to economic occupancy, as the chart shows, our economic vacancy in Q1 was not that great. It was 12%. The continued use of concessions, which I touched on, combined with rising vacancy rates, increased our economic vacancy during Q1. Concessions are still a feature in the market, despite the improving occupancies. The use of concessions kind of ebbs and flows, but at any given time, our properties and our competitive market properties are offering up to a month. We're not really seeing the 2 months or more anymore, but we are seeing a month, sometimes a little bit more free, and also discounted rents. In our portfolio, this has been most challenging in certain submarkets. So, for example, Princeton, Texas, where there's a lot of supply issues. We've seen in excess of 2 months. I mean, 10 weeks of concessions in Q1. That's kind of backed off a little bit there as well, and we're seeing some return to kind of normal leasing traffic. But in these supply challenged markets, the concessions have been really much higher than we've seen in a long, long time. Now, the flip side is in other submarkets where there's not as much supply, or where supply is kind of going off, we're seeing strength. So a good example is the South Fort Worth submarket where our Republic Deer Creek property is located. There the supply really came online 2022 to 2023. A lot of it's been absorbed, not completely, but there aren't really any new deliveries coming online in 2024 or 2025, and we're starting to see strength there, and concessions drop considerably in our competitive market set. So there we've been able to push rents. That's just an example, but of how the supply really can impact the submarket even more so than the broader DFW area. You can have outsized impacts in certain smaller submarkets. So as far as our new lease rents, excluding concessions, we continue to see a downward trend in our new lease rents, with the bulk of the declines occurring at our Class A properties. I do want to note that for our portfolio, the rate of decline is, again, submarket specific. In some sub properties, we have made modest rent increases. I mentioned Republic Deer Creek. There's been some others, but in others, we've had to cut dramatically. And overall, those cuts have outweighed the increases. And so at the portfolio level, we've seen a general decline in our new lease rents, which is reflected in the chart on the side there on the new lease side. Now, the renewal rents, on the other hand, we've still been able to continue to kind of push through increases, although be it smaller than we were doing before. And while renewal percentages in our portfolio were dropping as a result, I think somewhat of the increases, that's kind of stabilized as well, as you can see in that bottom chart, as we're kind of hitting our normal renewal rates based on the past couple of years, as opposed to the second half of 2023, whenever we were seeing below normal rental rates for our portfolio. So if we want to move down to the next slide, please. So this is kind of our looking forward. On the last slide, I highlighted a few items that are on our radar going forward, and starting with occupancy and concessions. As we look forward to Q2 and beyond, it seems that the market is in a transition phase. The downward trends in rents and occupancy seem to have bottomed, perhaps. Leasing traffic began to pick up in Q1 and has continued to improve through the spring leasing season, although over the last couple of weeks it's slowed back down. However, our portfolio average, again, increased to 94% during the month of April and has kind of stayed there through May. So a lot of positive things, but I just want to stress, as we look forward, it's too difficult to tell if this is a reversal of trend or it's just seasonal leasing activity. One reason I say this is because despite the improving occupancy, the rent growth remains challenging, and there are a lot of concessions still in the market. Yeah, they've cut back. They're no longer 2 months free. They're maybe a month free or half a month or whatever, but they're still there. And our renters and those who are coming through the door are asking for them, they're expecting them, and they're shopping around, including the renewals. I just kind of touched on that as being a source of strength, but we are getting some feedback from our leasing teams on the ground saying, hey, this person has reached out to us. We sent them the renewal. They want to know if we can negotiate. That's stuff that hasn't happened for years, and now it's starting to happen as people are more price sensitive, and they're just seeing some of the deals in the market and are moving around if they find a better opportunity. So that's why I'm not 100% convinced that the bottom is in on rent rates or concessions. Perhaps, though, I think on the occupancy side, it seems like things have stabilized at least a little bit. A couple other bigger items, to touch on is real estate taxes. We're still in the appeals process for most of our 2023 real estate taxes. And now we received our 2024 notified values. As I kind of noted in the slide, they're surprisingly high. Actually, it seems to be a disconnect between the assessor's office and reality right now, to their benefit. Most of the properties, if we were able to get the price in a sale, we would sell the property today based on their assessed values. That's how far off they are. But that's what the appeals process is for, and we'll be working that diligently through the year to get those back down to a more reality-based assessment level. And then on the insurance side, this is another is a major item. As most folks are aware, insurance premiums have increased year after year after year. Well, for the first time this year, I think the major programs kind of kept their premiums flat. At least that was our experience as we kind of went through our renewal process. However, a big group left the Texas market, and that was State Farm. We had a number of our properties insured with State Farm, and State Farm for years had been far lower than the other carriers in the market. And so while, we don't use State Farm exclusively, or we didn't use State Farm exclusively, so we were aware of some of the big premium increases, and we're aware that they've kind of stopped this year. Our premiums overall have kind of increased because of State Farm exiting some of our properties, and we've had to kind of go to the other carriers and replace that coverage. So that's a bit of a challenge for us within our portfolio. But I think at the macro level, at the high level, it seems like insurance rates this year are not, we're not seeing the increases that we saw, from the major carriers and the major programs that we've seen for the past, 5 or 6 years of 20, 10, 20, 30% even, in previous years. And finally, the item I want to touch on was the capital improvements. This is, ongoing at our properties. We have prioritized kind of our value add capital improvements, and we will continue to do so. We have some big projects ongoing that we're hoping that will kind of, some are necessary, but others are more of just kind of, hey, this will increase our curb appeal or give an amenity or improve an amenity and hopefully help our retention. So those are the items we're looking forward to for the rest of the year, and keep you posted on that. That's it for operations, Kevin.
Cool. All right, thanks, Dave. All right, so we've got some time here for some audience questions and some of the questions that were sent through when you registered. Again, a reminder, if you have any, please feel free to drop them into the chat module or the Q&A module there on the Zoom dashboard, if you will. We'll try to get to it. So we've had a few come in here. Looks like, let's see. One's on the impact on multifamily sales volume. This looks like maybe something, Caesar, you can address. I'll read it off here. It says, with a 12% decline in multifamily investment sales in Q1, relative to the previous year, how is HLC Equity adjusting its acquisition strategies? And then are there particular markets or property types that we see as being more resilient or opportunistic?
Yes, absolutely. So in terms of acquisition strategy, so our strategy evolved over time. Previously we always looking at buying. We look at across all deals, Class A, Class B, looking at deal with existing loan that we can assume and deal with new financing. And previously we spent a lot of time looking at deal with free and clear debt with new financing, because those deal we can buy at a better basis. But the challenge with that is that the cost of financing is high. If you go out and get agency financing today, anywhere between it used to be 6.5%, now around 6% interest rate. And that's with experienced sponsor and a deal with good quality, stabilized multifamily. That requires to buy deal at a 6 cap or higher, right? To get neutral leverage going in is challenging. And a lot of seller will not they don't want to transact at that cap rate level. What I have seen a lot lately is, as I touched on it earlier, is deal would have assumable debt. We've been tackle some deal that you can assume existing debt at fairly attractive rate, sub 3%, like 2.7, 2.8% fixed, with a decent amount of yield left. But the challenge with those deals is that the leverage is not that great. If you're buying those deals with that existing debt at 50% leverage, it's not that attractive. We would consider those if the leverage level is around 60 or 65%, where the deal can pencil, but the seller, they assign a quite high premium on the assumable debt, which we don't think is not worth it. So for that, like, we've been pivoting our strategy, look at secondary market where you can buy good quality asset, less supply. So there's not that supply crunch that hurting the demand and also hurting our rent growth. But we spend a lot more time on the distress side because those deals now we start getting call, directly from the asset management team or special servicer from banks, asking us, we want to take a look at this deal, and those deals are a lot more hairy, a lot more work to go through to underwrite because we don't have a lot of data like a usually on market deal, and we have to spend a lot more time thinking through how to turn around the operations. But those present a lot more interesting opportunity to buy good real estate. So um, in terms of time that I spend on, probably 50% of my time now is probably on distress side between underwriting deals, sourcing deals on the distress. Yeah.
Got it. Great. Yeah. Um, yeah, I mean, I guess similar to distress or stress, I got another question here that's kind of tied to consumer financial stress relative to rents. Maybe Dave, this is something you can jump on. It says with American consumers increasingly using credit for daily expenses, how might this affect tenant stability and rental incomes across our properties?
Yeah, sure. I can take a shot at that one. I think it's a big deal. As I kind of touched on in that last slide, we're starting to see um, weakness in our, I don't want to say weakness. I just say there's certainly been some challenges with renters, and they're certainly searching for deals. So we have received feedback from our site teams and the people on the ground, just kind of giving general feedback of what our, residents are saying. And people have expressed challenges in terms of just, being stretched, their dollars being stretched. They are perhaps relying on credit cards more than they were in the past. And, people who, if they get into trouble, they lose a job or something, some source of income, something happens, we're seeing some tick up in delinquencies related to that activity. But I also think that people in general, because they're being stretched more for kind of your daily items, food, inflation, gas, that kind of stuff that's been increasing over the years. They're looking to save where they can. And that goes back to this shopping around for concessions for the best deal in the market, as far as rental rates go. Now for, this kind of newer thing that's come up where people are trying to negotiate their renewal rates and saying, hey, I can get this better price over here, and yeah, it's a pain to move, but I'm willing to move for $500 or whatever difference. So like those are the dollars we're talking about, and people are willing to to do that. And I think it does reflect kind of a weakening consumer market and consumer in general, based due to the inflation and everything that's been putting pressure on people and their budgets over the last year or so.
Got it. Yeah, no, that makes sense. Um, there's one that came in here that talks about, says, you talked a lot about distressed properties, and Cedar, I think this is targeted at you. Can you provide more detail on the types of distressed assets we're targeting, like assets we're going after? And then the second part of that is sort of the criteria. Maybe don't reveal your secret sauce, but what criteria we're using to evaluate these opportunities and kind of the risks associated with them.
Yeah, absolutely. So on the distress side, I would separate them out into three different buckets of distress. There is the capital distress, on the ownership level, what the way they structure the deals. The second vertical would be operational distress, where you have an owner that have, they either third-party property manager or their team is not that great, so just they don't know how to manage it. And then the last vertical would be asset level distress, where property, is in a, gets maybe a fire or, the quality of the property itself is not great. We tend to avoid the third one, the asset level distress, because those are a lot more complicated to tackle, and those are structural issues sometimes where it doesn't matter how much money you throw at it, it's not gonna solve the problem. We focus primarily a lot of our time on the first two, the capital and the operational level distress. Why? Because we know that we can come in and address the situations. I think one of our core strengths is that having our in-house property management team, and we've done the management, we know what it takes to turn things around. It's actually a core strength. We can, and a lot of distress deals that we see are in the market that we already operate in or have existing presence in, where lenders, brokers, and owner knows us, and we get those call off, direct to us at off market, say we have this issue, can you solve the problem quickly? We're looking for a sponsor that have capital and experience and expertise to turn this around, and you are in the short list of the few, and we just need someone to move quick. And those have become our core strength. It allow us to move quick and get deals at interesting basis. And so yeah, so for us, like in terms of what we're looking at strategy wise to look at distress, capital and operational, where we lean on our expertise to be able to turn things around.
Got it. Yeah. Looks like we have time for about one more question, and it's like it's tied to tech. So it says, what is the biggest problem not being addressed by data or technology solutions? And I would assume that this question is tied to operations. So Dave, maybe you want to tackle that one?
Yeah, sure. Yeah, so this is an interesting question, and from my perspective, it seems, in some sense, there seems to be a solution for every problem in technology right now, and take maybe a twist on this question, I would say that a bigger, the issue may be for us on the operations side. A lot of times, is actually having too much tech in a sense, too many platforms, and being able to manage that. There are at a given property, there may be 10 to 20 different logins that our property teams or systems that they're logging into daily or at least weekly to kind of manage the property. And it's a challenge. The integration between the systems is not always the best. And it's hard for, the property teams who have a lot going on every day, people coming in, people going out, to kind of, navigate all these systems. And I think things get missed as a result of that. Whether, it's a resident app or a PM system or a gate control system or, one of these many, there's the keys tracking systems, there's package systems, and they all have updates and they all have, reasons that people have to go in and make changes, and things get mixed as a result of just the difficulty in kind of keeping it all straight. I think to the extent that that we need a solution for another problem, that's not necessarily the case, but more of just being able to kind of navigate these solutions. I'm not sure what the answer is there. There are some platforms out there have kind of tried to limit the kind of bring it all in house and make sure the integrations work. But a lot of times those platforms give you limited choices on what you can do, and so kind of balancing the flexibility of having a lot of different solutions that give you the features you want with the management of those solutions is the biggest challenge, I think, for operations today. Not so much that there's a particular area where there's not a solution there. Now, if you look at like for example, kind of building off that problem, let's talk like marketing solutions. So we market all over the place. We have pay-per-click advertising, we have websites, we have internet listing services that we use. So there are locators that we use. And so tracking all of those sources and making sure that they're all aware of our specials and they're all aware of our pricing changes, it's more difficult than it should be. That'd be an area where if somebody was able to kind of create a solution, and maybe there is something I'm not aware of out there, where they're able to kind of pull that together for you and allow you to update in one place. It just doesn't really exist right now. It sort of exists within these PM softwares and within these CRM softwares, but it doesn't fully exist. And that's a challenge, I think, that we face on a daily basis, especially in markets where concessions and specials are the norm, and we're constantly changing them to kind of meet expectations. So it becomes a daily issue where we're looking and making sure, hey, is this special getting pushed to the right marketing sources so that people are aware of it.
Yeah, it makes sense. I mean, change is happening on a daily, even hourly basis, right?
Absolutely.
Cool. Okay, well, we're just about up on time. I want to thanks to Caesar and Dave, and of course all of you in attendance for the questions that were sent across. If we didn't get to your questions live here, somebody on the IR team or the investment solutions team is going to be reaching out to you directly to make sure that we get those addressed. I guess a little housekeeping before we wrap up. Although Daniel wasn't able to be here today, he actually has created a video with his perspective on the market, as well as some of the thoughts on what we covered today. So that's going to come across in some of the follow-up emails that we send out to you. So keep an eye out for that. We're also developing, as like a complement to this webinar here, we're doing a report version of the market update. So that's going to be like more of a downloadable copy-based report, highlighting a lot of what we covered today, but also a lot more. So keep an eye out for that in the coming weeks. But other than that, thanks again for your time. If you have any further questions or want to learn more about HLC or in our investments, certainly feel free to hit hlcequity.com. So thanks again.
Thank you.
Take care.